Welcome back to the deep dive. Today, we are taking a really critical look at Rattan India Enterprises, or RTN India. They build themselves as this multi-sector new age platform, and they're a huge, huge player in the Indian market. So our mission today is pretty specific. We're trying to give you the clearest possible picture by looking at three, well, very different sources. First, we have this incredibly ambitious investor presentation. It's just, full of explosive growth projections for EVs, drones, e-commerce. Then there's the news coverage. And finally, and this is maybe the most important piece, we have a cold, hard, technical stock analysis that basically screams bear market.
And that tension you just mentioned, that's the whole story. Our goal here is to really synthesize the company's grand vision, the bullish thesis, with the undeniable reality of its current financials and the market's obvious skepticism. We have to measure the astonishing scale they've built against the risk the market is clearly pricing in.
Okay, let's get right into it then. We're talking about a massive company here. Rattan India is a Fortune 500 company. They actually just jumped 25 spots to land at 363rd place. So that signals huge corporate growth, right? And here's where it gets really, really interesting. Despite that rank, despite the scale we're about to talk about, the share price is down 40 to 45% year on year. It's trading near 41 rupees. What on earth is driving that massive disconnect?
That really is the million-dollar question for anyone looking at this company. And to even get close to an answer, I think we have to start at the foundation, the whole philosophy that's guiding this pivot into high tech.
Absolutely. The company's philosophy is laser-focused on what they call new age businesses. They're targeting technologies they believe can transform the lives of, well, 1 billion-plus people in India, and they have these specific tenets. They have to be ESG compliant, direct-to-consumer, low capex, and crucially, they state their aim is to stay away from debt-heavy businesses.
And that strategy is, it's timed perfectly to ride the biggest macro waves in the region. They're positioning themselves to capitalize on India's push to become a $5 trillion economy. They cite these huge macro drivers, things like 86% smartphone penetration by 2028, the Aadhaar stack with 1.4 billion people on it, and 2.2 billion bank accounts from all the financial inclusion schemes. These are basically the digital highways that let their businesses scale so fast.
So those macro drivers support the 4 core pillars of their business. First, you've got drones, which is a 100% subsidiary called Neo Sky. Then electric vehicles, that's Revolt Motors, 100% shareholding. E-commerce, which is Cocoli Retail, another wholly owned subsidiary. And then finally, they still have a big chunk of Rattan India Power, about 19.81%.
Right, and because they're juggling all these very different high-growth sectors, they've put a huge emphasis on corporate governance, sort of as a risk mitigation tool. They point out that 50% of their board is made up of independent directors. And maybe more importantly, they've put together this advisory board with some, really eminent people. We're talking about the chairman of ICRA, the co-founder of Policy Bazaar. That whole structure is meant to provide strategic oversight across these very different bets.
Okay, let's dive into the actual operations. Let's start with e-commerce and Cocoa Blue Retail, because the speed here is it's staggering. According to their presentation, Cocoa Blue hit over 5,500 crores in revenue in just 2 years. We really need to pause on that number for a second. The source material points out that comparable businesses in India took 10 to 15 years to get to that level.
That kind of acceleration is, frankly, unprecedented. It just speaks to the power of those digital rails we were just talking about. If you want hard metrics, H1 FY26 revenue was 3,735 crores. That's a 17% jump year on year. In the second quarter, they were averaging something like 4.4 orders per second.
Per second?
Wow. Yeah. And to do that, they're managing over 1,500 active vendors and tapping into Amazon's network of 359 fulfillment centers.
But volume isn't everything, right? Yeah. High volume doesn't always mean high margin. What's interesting to me is their move into creating their own brands. They're building what they call a house of Gen Z brands. These are their own private labels, like Kari for ethnic wear or Pump for athleisure, and those grew by over 31%. That feels like a clear attempt to get off the, low-margin logistics treadmill.
That's the strategic play. It has to be. It's not just about moving boxes anymore. It's about owning that relationship with the customer. Now let's look at the next pillar, electric vehicles, Revolt Motors. Here, they are focused squarely on one thing, total cost of ownership, TCO. For the average Indian commuter, that's everything.
And the numbers seem to back that up. They calculate their bikes offer up to 70% lower TCO over 5 years than a petrol bike. Their example, the RV Blaze X, has a 5-year TCO of around 1,035,000 rupees versus a petrol motorcycle at 3,070,000. I mean, if you're a commuter looking at your budget, saving over 2 lakh rupees is just enormous. That feels like their single biggest selling point.
It is, and you can see it in their growth. Units sold were up 50% year-on-year in the first half of FY26. That's over 6,000 units. They've also been rapidly building out their physical footprint. They're up to 217 dealer stores in almost 200 cities.
And they're tacking some pretty high-tech features into what's basically a commuter vehicle. The RV400 is AI-enabled, it has voice commands, mobile controls, you can even customize the engine sound. It kind of blends practicality with that consumer tech feel.
And what's also crucial here is how they've handled regulatory hurdles. They proactively resolved all those past FAME 2 subsidy issues, paid back what they owed, and now they've got approval for the current PME drive subsidy. That's 5,000 rupees per bike. Getting through that regulatory process shows they're serious. And the fact that they've been able to hire top auto talent like Roy Kurian as president just underlines that ambition.
Okay, so now let's pivot to drones with NeoSky, and the timing here just couldn't be sharper, right? With everything going on globally, drones are now cemented as part of modern warfare and security. And NeoSky is trying to be a full 360-degree player. Product, service, and software.
Right, and this is a really high barrier to entry space. They have a license to manufacture drones specifically for defense, which gives them serious credibility, and we're already seeing the results. They delivered 60 Tavas AI drones to the Karnataka police. They're also actively engaged with the Indian Defense Forces on several high-profile projects.
And it's not just about selling drones, they're also heavily into skill development. They're running these specialized training programs for the armed forces, for women police, even for students at places like VIT Bhopal. This lines up perfectly with the government's push to build a domestic, skilled drone workforce.
And that government push is essential. The Indian drone market is projected to hit nearly 2 lakh crores by FY 2028. Plus, there's this big global shift away from Chinese-made drones because of data security concerns. NeoSky is perfectly positioned to capture a big slice of that non-Chinese demand.
Quick question on regulation. They talk about benefiting from GST 2.0. Is that an official government term, or is that just their branding for a series of recent rate cuts?
It's more of a convenient umbrella term they're using, but it refers to real changes. For instance, the GST on drones was slashed from 18% down to 5%. And for auto components, it went from 28% to 18%. So these are real favorable shifts that make their products more affordable.
Okay, so we've just painted this picture of a company that is, by all accounts, executing brilliantly on its operational plan. We've seen speed, we've seen scale, strategic positioning. Everything's looking great. So how does a growth story this good end up with the stock down 45%? Let's take a breath here and look at the financial picture, because this is where it gets, well, a lot more volatile.
Right. We have to face the numbers the market is actually reacting to.
So let's look at the results. H1 FY26 revenue was over 3,800 crores. That's a healthy 17% increase. And the first half actually showed a consolidated net profit of 106 crores. But then you hit Q2, and suddenly there's a sharp consolidated net loss of 397 crores. That is just a wild swing from one quarter to the next. It's enough to spook any investor.
It is, but what's so fascinating here is the technical reason for that swing. If you dig into the earnings commentary, almost that entire Q2 loss was driven by a massive unrealized notional loss, about 458 crores.
Okay, stop right there. For those of us who aren't accountants, can you walk us through that in plain English? What does unrealized notional loss and mark-to-market actually mean here?
Sure, and this is absolutely critical to understand the numbers. Mark-to-market, or MTM, is an accounting rule. Since RattanIndia Enterprises owns a big chunk of RattanIndia Power, they have to adjust the value of that investment on their books every quarter to reflect its current market price. So when the stock price of RattanIndia Power goes down, RattanIndia has to book an equivalent paper loss. It's an accounting entry. It's not cash going out the door from their core operations. Not from Cocoa Blue, not from Revolt.
So, to be clear, the massive loss that quarter wasn't because EV sales suddenly collapsed. It was basically an accounting adjustment tied to the stock price of their older power investment.
Exactly. That's what explains the negative EPS of around 2.87 in Q2. And we should note, the power asset itself, RattanIndia Power, is actually operating profitably. It's not about the health of the asset, it's about the stock market's valuation of it.
Okay, that explains the volatility, but it doesn't solve the bigger problem of the stock slide. The technical chart still looks terrible, so now we have to turn to the market's view. Why is the stock still dropping?
Well, if you connect all this operational ambition to the financial picture, the technical analysis confirms a bearish primary trend. The price is trading well below both the 50-week and the 200-week moving averages. That's a classic sign that sellers are in control. From a risk management perspective, everyone is watching the support levels. That 40 to 41 rupee zone is the key support band. If it closes below that for any sustained period, that would confirm the downtrend is continuing. And any move up faces a wall of resistance in the mid-60s to low 70s.
Then what's the momentum look like? Is this a slow bleed or a full-on panic?
Momentum is weak, for sure, but I wouldn't call it deep panic just yet. The RSI is in the low 30s. That suggests the downward pressure is constant. But we haven't seen that final massive volume capitulation that often marks a bottom. The risk is still to the downside.
So the chart is telling you to stay away from new long positions until the stock proves itself. This brings up a really important question, though. What is it that's really spooking investors? You said earlier their core philosophy was to stay away from debt-heavy businesses. But if some analysis shows a debt-to-equity ratio over 100%, isn't that a massive failure of their own strategy and maybe the real reason the market is so skeptical?
That is the absolute heart of the disconnect. The market sees a company growing incredibly fast, yes, but it also sees persistent net losses, even if you adjust for the MTM stuff, and high volatility. But the big skepticism comes from that execution risk. They're trying to win in EVs, e-commerce, and drones all at once, each requiring totally different expertise. And that, combined with the perception that they haven't stuck to their low-debt philosophy, is what's weighing on the stock.
So to sum it up, we have a company with explosive operational growth. They're scaling e-commerce faster than anyone. Their EV network is expanding. They're landing defense drone contracts. And yet, at the same time, they're dealing with huge financial volatility, these market-to-market losses, and a technical downtrend that just screams market skepticism.
Precisely. The company's entire bullish case depends on the successful scaling of these platforms, translating into stable margins and predictable cash flows. But the thing is, those stable margins and cash flows, they're just not yet visible in reported earnings. So right now, the market is valuing the massive execution risk of juggling all these verticals much more heavily than the impressive scale they've already built.
A phenomenal deep dive into that dual reality. Thank you for walking us through it. And we'll leave you, our listener, with this thought to consider. When you see a company like this one that is undeniably succeeding on the ground, scaling fast, but continuously posts these large, volatile net losses, what stands out to you as the biggest deciding factor? Do you bet on the top-line growth and execution, or do you wait for the profitability and stability to actually show up in the numbers? Thank you for joining us for the deep dive. We'll see you next time.